So it's March now, March 1st, very important national holiday. It's my birthday. Last time was Sandy's birthday. This time it's mine. Next time, who knows who it could be. Maybe one of you guys. Okay, so if you have clients who had registered for this, but they weren't available right now at noon, I got a couple questions about that. They will get a recording. Everyone who's registered will get a recording. The link works 50% of the time so far when I send out that recording, but maybe today will be one of the days that it actually works. I'm just kidding. It always will work. If you ever have trouble getting into it, just message me. And if you're watching on Instagram, hopefully you get a lot of value out of this, but you'd be better off watching the webinar, so register next time. Okay, so I still think that that there's huge opportunity in the housing market right now, and it's actually the opportunity gets bigger when the conditions worsen. And so that's what I'm going to explain today, is how, as things have changed with interest rates over the last month, because again, just like February was a whole different game and whole different webinar than what we talked about in January, it happened to us again and everything's changed again. But what I'm finding is that as these market conditions change quickly, it creates a lot of fear in the market, and that fear is actually an opportunity. So that'll be our focus today. Now, why would you listen to what I have to say on this and what Sandy has to say? Well, we both work in mortgage lending, and that's why we have a really good pulse on what's happening with the economy and interest rates and mortgage products and guidelines. We also both invest in real estate personally. So we're both trying to grow portfolios, both, consumers in this market, trying to digest the headlines and know how it should affect our own personal strategy for buying a home. So it gives us a unique vantage point on real estate and what's happening this year in the market and how you can use it to your advantage. I always have to start with this disclaimer though, because I do not think you should try to time the market. I think you should strategize for yourself personally. You should take note of the opportunities that I'm seeing, and then you should get specific advice, because if you try to catch a falling knife, you're going to bleed. So this format of these webinars, so you guys will know what to expect, is we always start by going over a market update. What's happening in the economy? What have been the major headlines? What should you have on your radar if you're active in the real estate market? And what economic news is important for you to be paying attention to? Then we always go over financing strategies. So take all that market news and data and translate that into strategies that you can use to win. And then we like to share success stories because it's fun. I should get rid of that, huh? Okay. So market update, that's not going to be the funnest part today. But we kind of knew that interest rates were going to be the biggest risk in real estate this year. They're the biggest factor at play for what's going to happen to home values and how the market will play out, whether we'll see homes appreciate nationwide or whether we'll see depreciation. They're 100% driving every trend that's happening in the market. So I need to give you an update today on what's happening with interest rates. We actually saw interest rates peak in November of last year, and then they started improving, and they sped up on their improvements in January. And we're looking really, really good at the beginning of February. When we did this webinar on February 1st, I was telling you guys the party might be over. We've left a buyer's market. We're headed towards a balanced market and possibly only weeks away from a seller's market. Well, everything changed then right around February 10th. So that was a big economic news week. On Wednesday, they had the January Fed meeting and they raised the Fed funds rate by 25 basis points, which was fine because that's what the market was expecting. So mortgage interest rates actually reacted favorably to that. And we saw improvement on mortgage interest rates by the Fed doing what the markets expected and hiking their rate 25 basis points. Well, it got even better because then Powell comes out and gives this really nice press conference saying that the Fed's going to start looking at month-over-month data rather than only year-over-year. So meaning they're going to start taking into account that month-over-month inflation is actually down, even if year-over-year isn't showing the progress yet. And that's great news because the Fed often gets criticized for driving monetary policy using year over year numbers because you're then reacting to like old news. You're not looking at what's happened and what's changed since just last month. So the markets also really liked that and rallied on that news big. But I think that Powell was privy to the bomb we were going to get on Friday in the jobs report, and that's why he could be so dovish in his statement. So Friday happens and the jobs report comes out showing 517,000 jobs. Was it 517 or 519? I don't remember. Anyways, it was over 500,000 jobs added. And that doesn't make any sense. Like Wall Street Journal that same week came out with an article stating like 32 companies that had massive layoffs. Like we knew about layoffs in the tech sector. We heard about like Meta and the big ones, but and that's concerning because tech is America's growth machine. But then we saw that the layoffs were filtering out into other industries. Disney was having massive layoffs. And if Mickey the Mouse is hurting, then America's hurting. Don't argue with me. That's a fact. But we also saw layoffs in like the financial sector, Goldman Sachs. So Friday jobs report comes out, markets take a shit. Like mortgage bonds did not react well. And it was just bad news all around. And then we find out that jobs report was basically like statistical magic and accounted for like benchmark revisions, seasonal adjustments, population control, bullshit. But we knew that because there's no way that with all the headlines of layoffs that we're adding that many jobs. But now that gives the Fed like it gives them permission to continue with rate hikes and still have the potential of a soft landing because labor market's doing so great. So we're realistically expecting now 2 more 25 basis point hikes in March and May. Again, though, remember that doesn't necessarily mean that mortgage interest rates will also go up. Last time they did that, mortgage rates did great because they did what was expected. Mortgage rates could even improve on a day that the Fed hikes their Fed funds rate. So that's important to understand that they're not the same. But long story short, we're back in the 6s now for a 30-year fixed. The Fed's target for inflation is 2%. So they're going to continue hiking interest rates until inflation is under 2%. Maybe they do it at a slower pace, but they've made clear they're going to keep going. The truth is, though, after the past like 3 months, even 6 months, the CPI's annual rate of inflation is already below 2%. So I think it's going to continue melting just very, very stubbornly. We saw that even with the PCE numbers that came out last Friday. Inflation is going to be stubborn, and you have to adjust your strategy for this year because inflation is directly tied to interest rates. They react to each other nonstop. It's what drives interest rates more than the Fed fund rate. So if we know that inflation is going to be stubborn, this is going to change our strategy. And it's going to change what I've been recommending for you guys so far this year. I do still think that we see rates come down by the end of the year. And I do still think that we're headed in the right direction. Like when you look at this year, I think overall mortgage interest rates will be on a diagonal line showing that they improved. But I think it's going to be bumpy. Like it'll go up, down, up, down, up, down along the way. There's some important dates to keep in mind coming up. March 10th, there'll be a new jobs report. So I don't even want to say what it's going to be because I have no idea. But it would be nice if it came out showing that we didn't add 500,000 fake jobs. March 14th, do we get a better inflation number? April is predicted to be bumpy like February was. So March might have some relief for us because it's my birthday month. But then April is going to be painful like February again. Oh, I was supposed to do the save the date when I told you those dates. Pretend that I clicked on time. Okay. So how do you use the fear in the market to your advantage? Because that's the whole point of these webinars is how do we take whatever the market conditions are and use them to win instead of being freaked out. It's definitely frustrating that interest rates can go from 5.875 to 6.875 in 3 weeks time. And for buyers in the market, this means that your pre-approval, your affordability has changed. So you have to be in very close contact with your lender to make sure you're updating this frequently. But mainly, I want you to use the fear to your advantage. And lots of people can't take this heat. Those are wild swings in interest rates. That means that what you could afford last weekend is different than this weekend. And that's a tough market to shop in. But if you can have thick skin, then you have less competition out there. So when I said the interest rates at the beginning of February looked really pretty, we got a 5 handle. That weekend, we also had all of our clients who made offers be in multiple offer situations. So that kind of sucks because then you're losing your ability to negotiate on price, to negotiate for any sort of seller credits. And now that rates have gone higher, a lot of people have stepped back out because they can't take the heat. If you can stay in, if you can afford to still buy something, even if it's not what you could have afforded at a lesser interest rate, it will make sense for you to buy because you will get yourself a great deal. When rates come back down, you'll be back in bidding wars. So you have to keep using the moment to your advantage. And a good deal is not dependent on your interest rate. A good deal is not dependent on the market giving you a pretty interest rate that day. A good deal is made in the terms. And that's what these webinars are designed to do, help you design the best terms or be aware of different negotiating strategies you can use so that you can put together a great deal for yourself on a new house. But again, I want to reiterate to be in very close contact with your lender. In reality, every house you're shopping for, you should be getting an updated payment breakdown from them on because the rates are changing that quickly right now. The market's that volatile and it makes a big difference on what you can afford. Let me check the chat real quick and see what these questions are. Oh, that's nice. Thank you. Thanks for the happy birthdays. Feel free to drop questions. You feel free to tell me happy birthday in the chat. That's great. But you can also drop your questions there and I'll make sure we get to them at the end. Keep clicking. Okay. So when I say that you should be in close contact with your lender to get an updated payment, I want to show you like why it makes sense to do it this way. So these were some clients that the realtor reached out to me, asked me to run numbers on a specific address. I did so. She said, though, we're probably going to offer 460, not 500,000, which is what MLS had. So I'm showing my clients putting 5% down at list price because I want them to see the difference that dropping down to 460 makes. So $40,000 reduction in price affects the monthly payment and affects the cash to close. Not a huge amount though. It's not like the cash to close only went down $3,000. You think, okay, I'm buying a $40,000 less priced house. I would have less cash to close, right? It does make a good impact on the monthly payment, but you can make a better impact on the monthly payment using the 2-1 buy down. And if you've been on these webinars, then you're familiar with this strategy. If this is your first time hopping on, the seller 2-1 buy down is a temporary buy down on your interest rate. So you are taking out a mortgage at the market rate of, on this day, it was 7%. You're taking out a 30-year fixed at 7%. Your loan is going to amortize based on the 30-year fixed at 7%. But the seller is going to contribute money to be held in a separate account to pay the payment difference as though your rate was 5% for the first year and 6% for the second year. So when you go to make your mortgage payment those first 2 years, you'll pay your portion and they will draw from this account that they took the money from the seller from to pay the difference, the payment difference. If you refinance before that 2-year time period's up, whatever's left in this account, you get to use as a principal reduction. So it's a temporary buy down, but it's also advantageous because you don't waste money buying your interest rate down for 30 years when most people don't keep a mortgage 30 years. And we are expecting a refinance opportunity in the next year to 2 years. I also wanted to show them offering $475 with the credit towards their closing costs because these clients are pre-approved and they want to take advantage of this market. They get it. They're ready to negotiate, but they don't have as much saved up. They weren't quite ready or didn't anticipate doing it so quickly. Well, once we educated them on the opportunities that were available and what they qualified for income-wise, they were like, oh man, I wish we had saved more because we really should take advantage of this window to negotiate a good deal on a house and quote unquote get it at a discount. Well, we can use a credit from the seller to cover your closing costs and bring your cash to close down significantly. If that gets you into the house, then we can address the interest rate later through a refinance. But my point here with this is that you want to have those numbers run for you every single time. And you want your lender to be taking into account certain strategies. And your realtor and your lender can work really close to do these. So I like the strategy of getting the house for less out of pocket right now, because I know that a lot of people maybe didn't think they were going to buy this year because they were initially following the news and listening to headlines and getting bad advice that, you know, don't touch real estate with a 10-foot pole. But if we can get you into the house with less out of pocket expense right now, I do think you'll have an opportunity to get a better interest rate in the near future. And I don't want you to miss out on the house because you don't have a ton of extra money in the bank. I'd like you to keep some for reserves, for moving expenses, and take advantage of having a seller credit get you into that house with less out of pocket expense. We're also headed into, in my opinion, we are in a full-blown recession, and I don't think there's any chances of a soft landing. And I think that keeping a little bit of money in the bank right now is a smart thing for all Americans to be doing, whether they are buying a house or not. So I like using the price reduction to reduce your closing costs if that's what it takes to leave some money in the bank for you to have a cushion and feel safe. I'm back to the strategy of comboing a price reduction with credits. We talked about this in January and February. I think it makes sense because the price reduction itself does not have a very dramatic impact on your monthly payment or your cash to close. But when you combo it with a credit from the seller to either buy down your interest rate or cover your closing costs or something along those lines, you can really take advantage of the discount. Also, right now, you need to be looking to hold the property at least 2 to 3 years. When we run most of our return on investment calculations, we find that if you're buying a house and needing to sell it in the next year or 2 years right now, it's going to cost you money. So let's go over how that looks. This is a $450,000 house, and the clients were putting 10% down. So should they buy it or should they rent it? Let's go back. Well, mortgage payment you'll see up here is similar to the rent. So you might think, well, renting isn't going to cost me more. Maybe I should rent. Well, we need to take into account inflation here again. The house that's going to cost you about $2,500 a month right now, whether you rent it or buy it, in 9 years, if we think about 6% annual rental increase, mind you, for the last few years, we saw 17% rental increases, but let's be more conservative and say 6% because these numbers are coming down. 6% annual rental increase means that in 9 years, that same house is now renting for $3,905, almost $4,000. So you have to be confident that your income is going to increase at that same pace for your housing expense, because when you rent, you're subject to a rent increase at the end of each term, whether you signed a 6-month term or a 1-year term, your landlord can jack the rent after that. When you take out a mortgage, you set your housing expense for 30 years. So you know what it's going to be. And it's kind of like your built-in protection plan against inflation, because as your income increases or you pay off other debts, that's just a benefit to you. You don't have to worry about covering a higher cost for the roof over your head. Also, when you own your home, I hate rent shaming. I'm never down for anyone shaming someone for paying rent, because there's situations where renting does make sense. And there are also other factors you have to take into account. And lastly, when you go to a restaurant and you buy your food, you never think, "Ooh, I'm paying for the restaurant owner's lease." No. So like, you're paying for a service. There's an exchange there. When you rent, you're paying for a place to live. It's not a complete waste of money. It's just that there's a better strategy out there where you spend the same amount of money, but you benefit yourself. So that benefit is the amortization game. So when you're paying a mortgage versus paying a rent, every month you're paying down a little bit of your balance. And over 9 years on a $450,000 house where you put 10% down, your amortization gain, the money you put into a forced savings account by paying down your principal and building equity in that way, is $50,000. If we think really conservatively about appreciation for the next 9 years and put it at 3%, the healthy market in the US appreciates at 3% year over year. Over the next 5 years, Reno's expected to appreciate at 15 to 20%. The last 2 years, it appreciated at over 20%. This year, we're expecting it to be pretty flat. So I'm just going to use 3% as the forecasted rate of appreciation. Your home value would go up $155,000. So if you're looking at this data, your net gain by buying a home, and this is after I take into account paying a realtor to sell it for you, and like repairs and maintenance over that time, and closing costs, your net gain after 9 years, your return on investment is $184,000 just for paying for a place to live. You had to pay it anyways. You could have rented. So that's a really good return on investment. And there's very few asset classes that can net you that. But to come back to the point I made on the previous slide, years 1 and years 2 are red. So I don't want you buying a house right now trying to flip it in the first 2 years. You need to be planning to hold it at least 2 to 3 years because of the way the market is right now, because of the way interest rates are right now. I hope that's making sense. Now, Sandy, Sandy, you need to join the live. Has big news, you guys, from HUD.
Okay. Am I on?
I hear you.
Okay. Okay, everyone. So FHA mortgages are dropping it like it's HUD. Sorry, a little mortgage humor for you. Oh, that's yep. Okay. So HUD recently announced that FHA mortgage insurance premiums are getting cheaper by about 35%. Woo! So what does this actually mean? For the median priced home, okay, I think we're getting an echo. Okay, so for the median priced home in Reno, that payment monthly is going down by approximately $112 a month. So that's over $1,300 annually, which is pretty impactful. The other way you could look at this is increased affordability. So if your maximum that you could qualify for was $470,000 with the larger premium, now you could boost your buying power by $20,000 to $30,000. So that's pretty substantial for first-time home buyers and a lot of other people. You don't have to be a first-time home buyer to use an FHA loan. So it's pretty substantial what is going on. Another huge win is that All Western Mortgage is actually honoring this change starting today, which is almost 3 weeks before it officially goes into effect. So we actually have clients in contract right now that got in contract weeks ago. And if they were getting financing through another bank, they would actually not have their payment lowered by $100 a month. So pretty exciting, especially when you look at the actual tangible numbers of it.
That's super cool. And super cool that we're doing the best job of honoring it quickly. Okay. So hopefully you guys heard about that already, but if you have any questions on how it works, Sandy just broke it down really clearly, better than a lot of the ways I'm seeing other people do it online. Reach out to us, we can explain. And if you have clients that are currently in contract and their lender's not letting them take advantage of the lesser premium, tell them to do it. And if not, you're going to send them to us. Okay. So for all my homeowners on the call, I released a video this week and I didn't realize it would resonate with so many people. So I want to talk to you guys too, if you own a home already and are feeling trapped, because so the video I posted was, are you stuck in a house you hate because of a payment you love? And a lot of Americans, like I think I read somewhere 67% of Americans have a interest rate below 4% right now. So they might be feeling like they're stuck in that house, even if they've outgrown it, if it doesn't fit their family's needs anymore. And I think a lot of people, it's making people feel trapped. But you don't have to feel trapped. Like you're forgetting that there's other strategies, or maybe you were never made aware of them, but that's why you're here. That's why you're on this call and I have your back. So you don't have to stay in that house just to keep that payment and keep that rate. Keep it. Keep the house and keep the rate. Keep it as a rental. You'll likely have better cash flow, right? Because that payment is low due to a low interest rate and the market rent is high. You could probably make better money every month to keep that house and use the better cash flow from the house that you kept that has a very nice low monthly payment. You're not giving it away. You're not wasting it. You're not throwing it away. You're using it to have better cash flow and take that extra money to help pay your new mortgage on a bigger house that's nicer and makes you happier and costs more money. You use that extra money to offset it. You get to buy that house at a discount. It fits your needs. And down the line, when you refinance it and the payment comes down, oh shit, you still have that extra cash flow from the other house. Keep using it now for whatever you want to use it for, right? Like it doesn't go away. You don't lose that payment. You don't lose that magical interest rate. You can keep taking advantage of it. Or when you sell that house, say you need it. Say you need to sell that house for your down payment funds. You don't have, keep in mind when you're buying a new primary residence, you'll again qualify for minimum down payment programs. So you could probably get away with putting as little as 5% down, or you could use FHA and do 3.5% down, but you can put a minimum down payment down again on the new place because it's a primary residence. Let's say you don't have that though. You don't have any of it. So you do need to sell your house. Well, rates came down and you had a magical interest rate on that house. But odds are I'm expecting that you probably were in this house 5 years at least before you outgrew it. The average American does this every 6 to 8 years. Feels like they need to move, they've outgrown the house, or their needs change. Well, over the last 6 to 8 years, our country has seen some of the best rates of appreciation year over year in history. So you probably have a good nest egg in that house that you're going to be using as a larger down payment on the new place. So you'll need less of a mortgage. So if you haven't had the numbers run for you and you're just not even looking into it because you see, I have an interest rate of 3% right now, while interest rates are 6%, this is not going to make sense. It might make sense because you might need a lot less of a mortgage than you think to buy a house that will better fit your needs. And you get to buy that house at a discount. Have I said that enough times yet? So it's all about having an opportunity seeking mindset and perspective. You are not trapped. And then Sandy's going to share a success story before we jump into a quick Q&A because we're at 30 minutes.
Okay, awesome. So we had some clients recently close. Sorry, I'm getting the echo again. So we had some clients recently close on a home here in Sparks from all the way across the country. So they were able to move in with one fell swoop after closing. We did everything virtually. They signed remotely. And the great part was that they had been in love with this home for months. Their realtor had gone, given them virtual tours multiple times. They submitted their first offer months ago. The seller didn't actually accept it. It stayed on the market. They put another offer in, and the agent really negotiated and pushed for it. So she got all the terms and even got their offer accepted with it being contingent on the sale of their home in Pennsylvania. So it's huge. And it's just some of the examples of how having a great team who can really negotiate and have your back and walk through all of the logistics makes all the difference. And some of the opportunities that you might see on homes that are in like a larger price point that have been sitting for a while. It might be, time to go ahead and swoop in there when the seller's really getting ready to leave. So having a great team really does make all the difference.
Awesome. Okay. So before we wrap, does anybody have any questions? Jessica Johnson had said, how much was the seller contributing to the buy down? So the easiest way I found, you need to have the lender calculate this for you because like I said, it's a payment difference and it's going to be specific to what your credit score is, the price of the home, how much you're putting down. But the rule of thumb we found that seems to work the best is if you calculate 2.5% of the sales price, it'll typically be what the seller has to contribute for the buy down. But again, just ask us and we'll run the numbers for you. Good learning resources for people in the industry. These webinars just keep coming. Sydney was saying she's seeing lots of multiple offer situations. Again, I was seeing that too. I wonder though, because the market's like a week late, right? What we see happening as people make offers is a week late for what we're seeing happening with interest rates. So I'm very interested to see like how this weekend and next week go now that we're seeing rates in the mid to high sixes again. Anyone else on the call who's in the industry and has noticed any weird things happening? Let's see.
There's lots of buyers out there. All my listings are getting a ton of showings, and so there's people hovering around. So we just got to stay diligent.
On Instagram, someone asked how long someone has to be in a home to refinance. You don't actually have to be there a certain amount of time to refinance. But Freddie and Fannie did just change their guidelines to do a cash out refinance. And it used to only be 6 months and now it's going to be 12. What would you say to a very well-qualified buyer that is very rate nervous? Stop focusing so much on the rate. Focus on the monthly payment and find a strategy that gets you a monthly payment that you feel comfortable with, because we all obsess about these interest rates and we want to talk about it on the golf course and tell our friends, but it doesn't matter. What matters is the monthly payment you end up with. So use a strategy that gets you a monthly payment that you're comfortable with, keeping in mind a strategy that you have in place with your lender for the next 2 to 5 years on how you're going to manage that debt. Okay, guys, I am just gonna put up the QR code if anybody needs to schedule a one-on-one so that you can grab it. We're happy to do strategy calls with you individually, whether you're in the industry or a consumer. We want to help you take advantage of this opportunity and not be scared, not be one of the people who's afraid in this market, be one of the people who's winning in this market. Thanks for joining, and we'll see you guys again next month.
Thanks, everyone.
Oh, let's make